session. Our topic is preparing for capital and essential financial documentation. So during this first hour, my intention is to talk to you about the things you need to know so you can be ready to talk to lenders and investors. That's what this first hour is about. The topics I'm going to cover over the next 45, 50 minutes or so, and this usually actually takes the, up until right till the panel begins, these 6 topics. First, understanding your value proposition. Number 2, knowing your customer and industry. Number 3, what is your growth strategy? Number 4, how will you pay back the money? Number 5, building a relationship with the funding partners. And then 6, essential documentation. These 6 components are absolutely essential for you to prepare and practice how you address these topics, because when you talk to a lender, these are the things they usually want to talk about. These are the things they ask you. So I want to make sure that you're at least prepped tonight so that you have time to put together your answers and really be ready to talk to a lender and have a great conversation with them. If you've been through this program, you shouldn't be going in and begging for a loan or anything like that. You should know in advance what you need, walk in there prepared, be able to talk about your cash flow. And if your credit's in order and you meet the other guidelines, you should be able to get funding. That's what this is about. So let's just jump in. First, understanding your value proposition. Okay. Now we talked about this a few times in the class, but it's really important that you have a concise, clear way of describing what you do. And you have a concise, clear way of describing the benefits that you offer customers. And you have a clear understanding of who your customers are. So for example, if a lender says, hey, nice to meet you, come sit down, thank you. So tell me about yourself. What does your company do? Well, thanks for having me. My name is Will Holmes. My name of my company is Will Holmes Consulting. We started in 2006. Our customers are government agencies, banks, and universities. And we've worked with thousands of companies over the last 16 years, really helping these organizations to become more efficient and increase revenue and implement new technology, new processes, new websites, new customer relationship management systems. And what our customers say that we do, or we do for them, is they say that they feel like we're able to really lead them through the process. They feel like they can trust us. They feel like they can count on us to deliver as promised on time and on budget. And that's why we get, and most of our marketing actually is really done by our clients. They refer us business because they're very happy with our work. And they're confident that when they introduce someone to us, we're going to do a great job for them. So that's like that encompasses all 3 of those questions, right? I usually start with something like that because I know what they're going to ask me. I've been through this a few times, but you may need to ask questions. You may need to say it in a simpler way. Like, hey, tell me about your company. Well, my company is a business management technology consulting firm. We work with government agencies, banks, and universities. Oh, really? Okay, wow. Well, where are you located? Located in Baltimore. All right, well, tell me what benefits your customers experience. And then you break it up like that. Whatever is more comfortable for you is fine. I've been doing this a long time, and we've gotten a lot of clients funding. So I know what they're going to ask, but at least you should have these answers written down. Also, and prepared like a script so you can practice it in front of the mirror, or however you do it, so you can memorize it. And also it should on your website, it should reflect these same types of words. So if they look and on your marketing material, on your business card, when they look at all of your material, it should all say basically the same thing. So it's really clear who your customers are and what you do and the benefits that you offer. And also, if you have questions about any of this, please just, of course, put in the chat or raise your hand, and Mr. Brown will let me know you have a question. Second, preparing for capital is knowing your customer and industry. So we've talked about this numerous times, but knowing your customers' buying patterns and history. So when you look at your cash flow projections, which I know that you all have been working on and you are super excited about them, it should show when you say I've got 0, 0, 0, then $10,000, and the banker says, well, why is it 0, 0, 0 next to government contracts? They already know the answer. They want to hear you say it. Well, usually they don't pay. I start the work in January, but I don't get paid until March or April. Makes sense. And I say, well, how does it work with working with the government? Well, they usually have to, usually it's like a 1 to 2 year process really to kind of get a contract. I may talk to them in advance, or maybe the RFP comes out, but it's usually about a year of going and meeting with them and talking to them, and then making sure that there's funding, and then of course making sure that it's in the budget for the next year, and then going through the proposal process, winning the bid, and then of course starting the work in the, sometime within the next 8 to 10 months. So saying those and that's government. Obviously, it's different with direct to consumer and business to business, but you would need to understand that, and it should be reflected in your cash flow projections. Okay. Number 2, how big is the market and what is your share? So remember when we were talking about marketing and selling B2B, B2G, B2C. When I talked about where to go for information, I gave you that download. One of the links was census.gov. Well, why is that? What does that have to do with the market? So let's say if you identify, let's say if your target customers are people, individuals, and like direct to consumer, and you know that let's say let's use Samantha's business. Let's say her business, most of her clients are women, maybe ages 21 to 70, and they live in most of them, let's say most of them are Caucasian, and they live in like a 10-mile radius of Anne Arundel County. Like they're in Anne Arundel County, but more specifically a 10-mile radius maybe, or a 20-mile radius of Annapolis. You can, and using those zip codes, you can go to census.gov, and if you know the demographics of your target market, you can see how many of them live in that area. Then that can help you with geo-targeting, either with social media ads or mailers or flyers, however whatever is the best channel to reach your target customer. Or maybe it's referrals from other businesses, people who that same shared market that go to these other people that aren't competing with you, but maybe have the same shared target market. It allows you to figure out how many there are in a certain area. So if you know there are 1,000 of them, right, and you know that in your cash flow projections, you need to maybe sell, you at least need to have 100 of them by every single month, then you would know, okay, well, maybe 10% is maybe too high for a market share, because usually a conservative market share is like maybe 2 or 3%. So maybe you need to expand out, or maybe include other people. Maybe it's not just Caucasian women. Maybe it's Latino or African American women. You do the numbers. You say, oh wow, there's more women to choose from, and you start to market to them. And by having a larger market and a conservative market share, a conservative percentage, it allows, and that should allow you to hopefully hit your goal. Of course, if 100 of them buy. But you have to, the same way I just explained that, you have to be able to explain that to a lender. Where are your people, and what percentage of them need to buy? That's really what the market share is about. Number 3, what does your competition do well? So a quick way to end your meeting with your lender is if they ask you who's your competition, you say, oh, I don't have any competition. I'm so good. No one competes with me. No one does what we do. That's the quickest way to end that meeting. Because what they're looking for is to see if you've done your market research and done your due diligence to see who else your customers would possibly choose from if they did a Google search, or if they did any type of research at all to make a buying decision. Who else would they be considering? And so you need to know that. And so so when they ask you that, so what does your competition do well? Well, our competition, we have Brownie and Motion Consulting. They're a fantastic consulting firm, but they focus mostly on, and they're in our area, but they focus mostly on operations and project management, where we're more so marketing, sales, and technology. Okay, and they're good at that, but where we're really strong is we're really strong with helping customers to make more money. And then, so it's not beating up your competition, it's just really having a strong understanding of where they're strong and where you may be stronger in a particular area. Number 4, your sales projections. Once again, your cash flow, right? We went through how to figure out your pricing, and we've learned how to figure out, okay, what are my expenses? We learned how to figure out what's my potential profit. But that top revenue number, that top line number is really going to be based on how many sales you do. And so, and of course, your sales should pay for your expenses, right? But they should also cover that profit margin you're going for. And so in your revenue, in that top part of your cash flow, and it says how much you make per month, that you could say, well, look, if I'm doing one, let's say $1,000 every month in this particular revenue line, that's equal to maybe 10 sales, because we sell that for $100 each. Each box in your cash flow tells a story. And I keep referring back to the cash flow because that's what the lender uses to have a conversation. In fact, if you pull that out and start with that, you probably cut your meeting time in half, because that's what most people don't understand it. So if you go right to it, one, they're going to be very impressed, and you are automatically speaking their language. Number 5, how is your industry trending? Okay, so you always want to pay attention to what's going on in your industry. So if let's say with crystals, let's say there's a shortage because most of them come from an area where there is maybe COVID is affecting you getting your crystals. So what you would need to know that, and in turn, what does that do? Does that help you? Does that mean you have to increase pricing, or is demand, or is because demand is so high, or maybe because demand is just normal demand, but you have a lot of product, maybe you have to decrease your pricing to sell it faster.
Mr. Holmes, we do have a question in the chat.
Yes.
Lydia asks, at what point in time do you start cash flow? Do you use past months to show a trend, or just start it this month and each month after?
And normally, what the lender will look for, anything that's in the past, they want to see your bank statements and your profit loss from the past, your balance sheets from the past. And then going forward, those would be projections. So it would be, this is April, probably want to walk in there. I mean, if you go in there with like a 2022 from January to December, and it's still April, that's not bad. That's still showing, it's still like 5 or 6 months. But in many cases, though, they may want like 3 to 5 years of projections. And so instead of it just being 12 months, they would probably want to have you extend it out. So either you could take that same tab and just add more columns, or have one for each year. It's probably easier to have one for each year in case because they probably need to print it out and submit it with the actual packet. So essentially just copying it, starting off where you left off from the prior year, and then just taking and just looking at the numbers and seeing what kind of increases in revenue you have, what kind of increases in the actual expenses. And normally what is reasonable to a lender is that you're getting, with inflation, like I think our inflation right now is like 6.9%, something like that. I think I heard on Bloomberg yesterday. But you want to account for inflation in your expenses. So if the expenses are going up 7 to 8%, then your revenue is going to need to go up, maybe 8 to 10%. And you would need to be able to show, well, look, my expenses are going up because of inflation. Everyone else's expenses are going to be going up as well. So we're very confident that we can increase our pricing, because if not, we're not going to be able to stay in business. And customers should understand that, because everyone else is going to be increasing the pricing. You have to be, and that's pretty much how you have to explain it. But so going forward, we're probably going to need to extend it out 36 to 60 months. And then, but going backward, they just really want to see your bank statements and your tax returns. Did that answer your question, Lydia?
She says yes.
Awesome. Thank you. Thank you both. Okay. And then what's next in your industry? You may know, maybe you're the trend setter. Maybe you're the one that's really setting the pace. If not, that's okay. At least maybe you're paying attention. Maybe you're getting trade magazines, or you're a part of a trade association. They're sending you a newsletter. If you're not a part of any of those, I recommend being a part, because that keeps you up to date with what's going on. And they usually have expos or meetings. You can go and see the latest technology and the latest techniques. If you're planning on staying in the business a long time, I recommend at least looking for other people who do what you do, so you can share resources and maybe you can get a little mentoring. Next, what is your growth strategy? So actually, Lydia, that was a good question because as I'm saying right here, they're going to want to see at least 1 year, 3 year, 5 year projections. So taking your cash flow out, you know how to do 12 months. So it's the same thing. 24 months, 36 months, 48, 60. Taking it out, one tab for each year, building upon the next. Number two, how does funding help you grow? So ideally, what lenders and investors look for is that you're spending money on things that will help you to make money. And in fact, let me go a little further. One thing that I know that they will question, they're gonna say, oh, you're looking for $100,000 from us and you're paying yourself $80,000? So you're gonna use our money just to pay yourself? So, I mean, those kinds of things are red flags for a lender and an investor. So instead, if you're saying, well, I want to spend this $100,000 on more salespeople and more marketing and maybe some administrative people to help deal with all the new sales that come in, and I need a new website, and I need a new customer database, a new customer relationship management system. I need someone to handle my social media. That's because those things are investments in your business that'll help you to make more money. And that's what you want to talk about to your lender. Number three, how much of your money will you invest? They want to see your skin in the game. So how much have you put in? And how much, and what are you going to be paying yourself? All those kinds of questions really show to a lender how serious you are. Because what they don't want to have happen is, oh, this is risky, isn't it? Oh, you want to use our money, but you haven't put your money in at all. Gotcha. No thanks. We're out. Number four, what needs to happen for you to grow? And also, what are your assumptions? So if that, you would need to say, well, okay, I need to hire more people. I need to achieve my sales goals. I need to manage my expenses. I need to make sure I at least generate this much revenue. I need to hire certain types of skill sets. Those are very specific actions. And then assumptions would be, well, these numbers are based on us having a market share, like a conservative percentage of possible customers, at least at 3% or 4%. And this is also based on our inflation, basically the price of things going up at like a 7 or 8%, because based on what the market's doing right now. And even if it's and with that we still make money, that's a good thing. So, and also assuming that people will continue to buy like they have been over the last 50 or 100 years, whatever it is that you sell, right, in your industry, if it's been around that long, and that people will continue to use the internet. They'll continue to use money and cash in the normal trading system that you already have. And so then, and when you say those things, they have to say, what happens if there's a pandemic? What are you going to do? Well, I had that experience. We survived the pandemic. Our business survived the pandemic, and we were able to pivot and do this. We already have a plan for that. Those are the kind of questions you can expect.
I have another question in the chat, Mr. Holmes. Samantha asks, does the lender solely base their decision to invest on your personal credit? Also, what if it's your slow months and you don't show a lot of money in the bank? Does this actually affect their decision? I don't know if this will come with 5 C's.
I will actually cover that, but that's a great question, Samantha. Thank you, Mr. Brown. So yes, your personal credit, especially if you're just starting out, and normally strictly, this is what M&T tells me and Wells Fargo, they always say, yes, these loans are based on you, because we need someone to be to guarantee these loans, a person to guarantee these loans, even with business. If you own that business, they need you to guarantee it. And that's what in fact, we just had this panel last night. They all said the same thing. They were in agreement on that. So your credit score probably needs to be, well, depending on what kind of lender you go to, you probably want to at least have it above 550. Anything lower than that, it's really, really difficult, and you're paying tremendous interest rates. But probably having it like maybe over 680, 690 gives you a lot more options, either with larger banks or CDFIs and other financial institutions. CDFIs are community development financial institutions, and they're developed to work with people who maybe have lower credit scores, little to no collateral, and that's what they do. But their interest rates they're probably not as low as traditional banks, maybe a little higher, but not, and probably not in the double digits, at least not right now. So your question as far as your personal credit, yes, that is a very big part. As part, and we're going to talk about the 5 C's in a little bit, but that's a big part. In fact, it's the biggest part, about 35% of the weight. Of the weight, when they weight your score, it's about worth 35%, your actual credit history. But you can fix it, especially if you go to the credit bureaus, Equifax, Experian, and TransUnion. You sign up for the monitoring services they offer. It's like about 19 bucks a month each. And then you just do what it tells you to do. They have score simulators. So let's say if your score is 600 now, and you're trying to get to 750. They'll say, well, you know, how quickly do you want to do it? They'll say, nope, can't do it in 8 months, but maybe you can do it in 16 months. And they'll tell you the things you have to do. Okay, pay these things off, deal with this charge off. You're going to need more of a mix of creditors. So once, you know, you're going to need some small credit cards to get started, and you pay them on time. Like, it tells you very clearly what to do. So I highly recommend, you know, if that's a concern for anyone on the call, to go ahead and start, you know, paying attention to your credit score and working on it. The second part of the question, oh, I blanked out. I'm sorry. What was the second part of the question, Mr. Brown? I'm sorry.
What if it's your slow months and you don't show a lot of money in the bank? Does this actually affect your decision?
Yes, it does. But everything, if you have a good explanation for things, and also, so it's a combination of, okay, these are our slower months. It's the winter time. People don't really come out because it's cold here. And the thing is, bankers know, because especially in retail here on the East Coast, especially up north, it gets really cold. And if you're near the water or you're in the cities, we usually see a dip in traffic, foot traffic. We see a dip in retail sales. Until maybe you get around Christmas or the holidays, then usually there's hopefully some kind of jump in many cases. So they're going to be familiar with your industry. Also, there's a lot of data on your industry that they have access to. And so they would look at that and see if that's normal or not. Also, they'll ask you, okay, well, look, we see that every year you have a really low October. What are you doing to address that? And and it may be, well, we've been working on that, and here's some things we've done, and we've seen a small increase year over year, but it's just nowhere near like our normal months. And that may just be the answer if you stay in your industry. Or you could say, well, look, what we're doing is we're selling other things. Like what we're doing is we're offsetting that shortage by selling other products online. We've got this on Amazon, or we've got these other things we're doing, or I'm doing speaking engagements. And that helps to also offset the money that we don't usually make in this time of year. As long as you have a logical answer or reason, that's what they're looking for. So, and these are the questions they ask. So I want to tell them to you in advance. That way you can start to prepare. Okay. Samantha, did that answer your question?
Thumbs up.
Awesome. Thank you both. How will you pay it back? So in your cash flow projections, you would add a line that says, okay, this is, some people call it debt service, like paying back the debt, loan repayment, whatever you want to call it. The lender's going to say, well, how will you pay us back? Well, if you look right here in my cash flow projections, here in line 42, it says debt, loan repayment. We're asking for $50,000 because that covers the first, let's say, 3 to 4 months that we're going to need before we open up the shop, or we roll out this new initiative, or open up the new location, right? It's going to cover that, because we figure after that we should start making money, and then in that following month, in month 6, we can start paying you back. And we looked it up online. For that amount of money, paying it back in 7 to 8 years at a reasonable interest rate, we were probably paying like $600 or $700 a month to you. And that's listed right there. And as you can see, we still have a good profit, even with paying you back. That tells the lender you're thinking about it, thinking about paying them back, which is good. You have the money to do it, and you have money left over. That answers like 10 questions that they would probably ask you. So make sure you have that ready. What kind of loan do you want? Okay, so if you're looking to maybe buy a vehicle, that and it's let's say $50,000 vehicle, that would probably be a loan where they cut you a check, you take that money and buy whatever you're going to buy, and then you have consistent payments over time, and that balance over time drops. okay? That would be a loan, like a term loan. Or it may be short-term, where you want to have essentially access to a line of credit and then you pay it off. So if a loan, a long-term loan, the balance looks like this over time, a credit line will look like a heartbeat, where it's like up because you ran it up in the middle of the month to cover payroll or whatever, right? And then you got paid by your client and then you paid it off. And you ran it up the next month, paid it off, ran it up, paid it off. And that's what they expect with a line of credit. If you run it up and it stays like that, that's to them, to the bank, that's very scary. They wonder, well, why aren't you paying it off? They think maybe you don't have any money, and they may either close a line of credit or even convert it to a term loan. But you should talk to your lender, stay in touch with them when these things are happening. Next, do you need investors, partners, or lenders? So once you do your cash flow projections, you understand, okay, for me to grow, I need this much money. And you would say, okay, well, I'm going to go to a lender and see if I can get a loan or a line of credit. Great. Or I can go to an investor and they'll say, well, high risk, high reward. How much do you need? 50,000? Okay. If we do 50,000, we want 250,000 back in 5 years. So we want to see your 60-month cash flow projections and show us how you're going to be able to pay us back in 5 years. And then you'll still have enough money left over to keep your business going.
Mr. Holmes, Dupe has a question. She asks, do you pay off the entire amount on the line of credit monthly?
I'm sorry, say that last part again, Mr. Brown.
I'm sorry. Do you pay off the entire amount on the line of credit monthly?
I mean, that's what I recommend. And that's also helps you to build up your business credit score. They usually like to see you pay off things quickly, ideally in the same month. So that's what they are looking for. If you can't, and you have to, and that happens, I mean, that's the whole point of having it. If you have to keep it going a couple months, that's fine. They may call you. And I mean, as long as you're making your minimum payments, it's like a credit card. Then you're okay, but then you're gaining interest on that balance. And then the bank probably is going to start to wonder what's going on, because they really expect you to pay it off relatively quickly. Okay. But if you keep a balance for a while, it's not, or even if you keep a balance low, especially if it's under 35%, they probably won't be too alarmed. They probably would not be as eager to offer you larger lines of credit anytime soon. Does that answer your question, Madupe? Excellent. All right, thank you both. And so what's in it for them? I'm sorry, partners. So partners, I'd say probably all investors are partners to some degree, but all partners may not be investors as far as financially. So a partner may be someone, let's say if Mr. Brown's company and my company got together to go after a contract, we'd be partners. Maybe there's no money involved unless we get the actual contract. Maybe your partners will say, look, I'm not going to give you money, I'm going to give you my knowledge. But I want, if this thing really works out, I want some kind of payoff at the end. It's totally negotiable. You can decide between you and that potential partner what works best for you. And it's, I'm sure you probably seen Shark Tank, and sometimes they go in, it's just strictly money. Sometimes they go with money and mentoring. It really depends, but you have to understand what's in it for them. So if they're an investor, they're going to want they want ownership. They want maybe a say in what you do. They want to come to the meetings. They want to vote. They want to make sure they protect their investment. Lenders, they just want you to pay them back on time. So when you're thinking about investors, partners, or lenders, investors, that might be equity financing, where they get equity in your business. They have control. Where lenders, it's debt financing. It's just debt. And they just want you to pay them back on time, as promised. Next, building a relationship with funding partners. Very important. I've been denied credit before. And I was embarrassed and all that stuff, and I walked away. But what I learned later on is that what I should have done is just talk to that lender and say, hey, can you tell me why I didn't get approved? Oh, well, we need your score to really be at least at 700 and you're at 650. It's too low. Like, okay. So if I work on my score, you think we can do some business? Yeah, you have everything else. Your score wasn't high. Okay. And it gives me a checklist of things to work on. And ideally, what I should be doing is meeting with that lender on a regular basis, maybe quarterly, giving them updates like, hey, my score has gone up. It's at 705 now. And then they may ask you some questions and they may say, hey, come on back in. Let's fill that application. Let's try again. But they have a checklist and you need to understand what that checklist is. And so you can essentially just work on things on your own and take care of those things. So when you come back, it makes it easy for them to give you a loan. Understand what's missing. That's your homework. And of course, make plans for future meetings with that banker. So I want to talk now about the 5 C's. You may or may not have heard of this before, but these are the things that lenders use to really determine if you are the right person for them to give funding to. Okay, so the 5 C's are conditions, capacity, capital, collateral, and character. I'm going to explain what those things are, but I'm going to start with character, because character to the lender is really your credit history. Because to them, that's your discipline, your financial discipline. And because it's so important, as you can see here, there are certain weights to the score. Payment history is worth 35% of your score. So they want to know, do you pay your accounts on time? Pretty straightforward. If you don't, then they don't want to lend to you because you've proven yourself to be, I don't want to say untrustworthy, but some of them may say that, or just at least someone who's risky, and they don't want to do business with the risky people. Also, something I heard last night, we did this panel last night, that they were talking about not only they also look at with character, they may call around to say, hey, do you know this guy? Maybe some of your past clients, look on your website, look on your social media, all those things. That's what they said in the panel last night. So all those things are important when it comes to your character, as far as they're concerned, and they're going to look at that. And in addition to it, of course, how are you paying back your debts? Number 2, your amounts owed. So you may have credit lines, or you have lines of credit, credit cards, whatever. Are they maxed out? If they're maxed out to a lender, that's really scary, because that means you're probably going to do the same thing to them. Or they wonder what's wrong. Is something happening in your life that's going to possibly make you default, not be able to pay? Next, they look at number 3, length of credit history. Here you have to be really, really careful, because I think a lot of us are probably taught debt is bad and we shouldn't have debt and we shouldn't have lots of credit cards. And that may be something that happened to your parents or their parents, whatever, and they decided, oh, we're just going to do everything strictly cash. And that's what you want to do, that's fine. But I mean, when you do everything strictly cash, you're limited to just the cash in your pocket. Normally, people don't have enough cash to buy a house or buy, or pay rent for a year on a lease or buy a car outright in most cases. That's why credit is needed, so you can get financing. So it's important that you understand that there's debt and then there's credit. Credit is that open line, that $1,000 of credit line they give you, and you have a 0 balance. That's great. That shows you're being responsible. It's there for a rainy day. Lenders love that. Also, makes your score go up every single month. If you have that $1,000, but it's at $855 and it stays there for a while, then the lender is going to say, oh, wait a second, they're not being responsible. And then in addition to that, with the level of responsibility and the lines of credit and things like that that you may have when it comes to debt, they also want to see how long you've had these credit lines open. So if they pull your credit and all of a sudden you have 5 new cards in the last month, oh, they may think, oh, something's wrong. Maybe something's happening and you're trying to get a lot of credit because something is going wrong, okay? Or they look at, oh, wait a second, they've had a line of credit, the longest one is only 2 years. Or maybe, hey, you've had a line of credit and it's 7 years long, or it's at least 7 years old. That's fantastic. To them, that means you have a history of paying your accounts. You have a history, you've been doing this a while, you understand how it works, you're paying things off on time. That's good. So if you have an old, the reason I start off with what we were taught about debt and credit being bad, if you have that old credit card, keep it open. Just be responsible and just keep the balance at 0 or keep it under 15%. Having that line of credit for a long period of time, that age of the line tells the lender, hey, this is a person we want to lend to. And that's good, because if you close it out, it'll probably drop your score maybe 10 to 15 points. Especially that was your oldest line of credit. Number 4, credit mix. So you don't have to have all of these, but remember this, they're using the score to incentivize behavior and also to essentially measure credit worthiness. So when I say incentivize behavior, they want you in the game. They want you to have lines of credit. They want you to have a certain amount of debt, and they want you to be responsible. That's what this is all about. If you have no debt and you have no lines of credit, then they're going to think you're risky and you don't understand and you're not in the game. So it's going to be very hard for you to get credit. And then if you do, it's going to take you a long time to build it up. And that's fine if you don't have any, but you need to understand, you have to be strategic about it. Be careful with opening. You don't want to open necessarily 5 credit cards in 1 month. Maybe do 2 in a month, and then maybe 2 more in a couple months later to start to build your credit up. And then you want to have a mixture. So maybe credit cards and retail accounts and installment loans, car loans, so finance company accounts. If you have a mortgage, great. You don't need all of them, but having a mixture is a good thing. They look for that. And then number 5, new credit. And this is the 5th thing under character. I'm going to go on to the second C in a second. But new credit, like I mentioned before, you want to be strategic about, if you're going to open a new line of credit, you should think about when you want to do it, plan it out. Because if you start, and especially if you're doing a lot of hard inquiries on your credit, we've got 10 inquiries in a month, that's going to make your score drop, because it makes the lenders think that you're doing something risky or something's happening. So you're going to try and open up a lot of credit. So you have to understand these things so you can play the game and you can have the highest credit score possible. So that's just the first C, which is called character, which really has to do with your credit score. Now we're going to go into the second C, which is capacity. So this is your debt to income ratio. So if you look at all of your total monthly debts, okay, and we look at your gross monthly income, that ratio ideally should be at 35% or less for a lender to think that you are being responsible. If it's higher than that, they're going to think that you're being risky, or you're a risky person. They may not want to lend money to you. So you have to make sure that you're keeping and it's not even a total 35%. It's really individual accounts. So if you know each individual account should be under 35%, you have to know that and monitor it. And also a trick is even if you run up the card, run up the balance, you have to know when they report to the credit bureau. When does your statement end? If it ends on the 17th or the 20th, you should make sure that account is paid down or paid off by the 14th, 15th, and then just leave it alone. Once they report, then take that 0 balance and run it up again. But you have, because if not, when they report it and your credit score when they report it and your balance is high, and let's say you had 0 last month, but you didn't pay attention and you let it ride, and now all of a sudden you have $800 on a $1,000 credit line. Oh wow, now you're at 80% utilization rate, and that even though the rest of everything might be at 0, it could drop your credit score down to 3 points or more. So you have to understand these things so you can keep your score as high as possible, because with credit, technically, if you do it right and you make enough revenue, you can have essentially an unlimited amount of credit, hundreds of thousands of dollars, if you have your credit scores high enough and you pay your stuff on time. That's probably way more than you have in your pocket. So it's really, really important that as business owners, we manage it, because all of our business credits can be based on our personal credit. That's where they start. Next, capital. What's your skin in the game? Oh, you want to borrow from us, but you don't want to use your own money? How much money have you put in? Oh, none? No, you're not serious. Number 4, collateral. So they don't want your old car. They don't want your equipment. They want you to pay on time. But if you have collateral, just in case something happens, which secures the loan, that makes them feel more safe. They feel more safe, they're more likely to give you a loan. This is, besides credit score, this is the number 2 reason why small businesses do not get funded. So be intentional on that car that you have or that equipment, knowing the value of it, because you may be able to use that to go ahead and get a loan. Number 5, conditions, market conditions. We just went through a pandemic. During that time, they were like, oh, we're not loaning money to restaurants, or we're not doing any more credit lines to businesses for a period of time. Those things happen. Right now, interest, I listening to Bloomberg, so I can stay up on this stuff. And you should, I recommend it. NPR, Bloomberg, take a break from music or whatever you listen to, and listen to it. Because right now they're talking about the Federal Reserve is talking about raising interest rates as much as half a percentage point, like basically, 50 basis points every quarter. So it could go up, so the cost of money might go up like 1.5% this year. That's what they're talking about, right? Because they're trying to offset inflation. And so, that's what they're talking about, and these things. And so you have to pay attention, because these things affect the stock market, which has an effect on the economy. And so you have to pay attention you want to make sure you're paying attention to these things to see what's going on with the supply chain. So right now, they're saying that in China, they've shut down some of the ports. So what does that mean? That crazy enough, the price of shipping is going down because less things are coming out. People still have a lot of stuff inventory from December, January, February, when they were buying a lot to try and meet customer demand. And also there was a delay, and they were ordering those things in the summertime. They finally started coming in. So stores are stocked with a lot of things. Trucks, their rates were so high, they're starting to come down because there's less things to move, right? Even though gas prices are up. So if you pay attention to these things, you can say, oh, wow, okay, how does this affect my industry? Is there an opportunity in this for me? How does this affect my customer? All right. So, but these market conditions, if you're aware of these things, you can have a really great conversation with your lender, and also help you to understand what they're talking about. And because one of the things that I want you to understand is that market conditions affect interest rate. So if you, on that money you're trying to lend, if your income can maybe only really afford a $600 payment, and they're talking about the market or the economy changing over the next year, and interest rates and the cost of money going up 1.5%, that 1.5%, depending on how much money you have or how much money you make, may mean you can't afford that car anymore. You can't afford that monthly payment anymore. So these are the kind of things I want you just to start to pay attention to. So when it's not just going, oh, I'm gonna see if I can get a loan. You want to have a conversation with a lender so you can intelligently talk to them, show them that you're paying attention, so they'll be more likely to give you some money or lend you some money. And then finally, essential documentation. So obviously we've been talking about cash flow projections, and that's really normally inserted into your business plan. I start with that with most clients when we write business plans, because the story is really in your cash flow projections as far as I'm concerned. And the rest of the business plan is really a narrative that explains each little box. So you look at your money coming in, let's say you got 3 ways you make money. Okay, what happens? What are the trends? All the things we've been talking about, and you show it in your numbers. Then when you go ahead and you talk to a lender, so when you talk to the lender and you're talking about your cash flow projections, and you're saying, well, look, I have government work, and the reason why there's zeros there is because they pay me at 90 days. I offset that in that time by doing more work direct to consumer. And this is the kind of money I can expect from them. And that's great, right? But you're using your cash flow projections to explain it. And then the business plan is really just a narrative to explain the money. And then you're speaking the lender's language, okay? So that's why I've been focused so heavily on the cash flow projections. That's why I want you guys to fill them out and really pay attention to it and use it to plan your business, because the numbers don't lie. That anxiety you've been feeling because you're looking at your numbers, you know, wow, I'm losing money. Yes, that's normal. Now we have to make a plan to fix it. All right. So when you go and talk to that lender, they're going to be able to hear that in your voice, that you're confident, you understand, and you have a plan to make more money and grow your business. And the amount of money you're asking for is shown in the cash flow. Like that first 3 months, whatever you want to cover, or whatever it is you want to use the money for, and your use of funds, it's shown right there in the cash flow projections. You're using that as the basis for asking for the loan. But besides the business plan, we're also going to usually ask you for your normal business documentation, like articles of incorporation or organization, your partnership agreements, etc. Make sure all that is legit. Also, of course, making sure that you're in good standing with the state. I think that's usually probably one of the first things they look at. If you're not in good standing, you probably can. I mean, it's easy to fix, but they're not able to give you a loan, at least not at that moment. Of course, they're going to ask you to complete a loan application of some type, personal ID. I've heard usually lenders tell me 2 to 3 years of personal taxes, 2 to 3 years of business taxes. I've heard some ask for more. 6 months of personal bank statements, 6 months of business bank statements. I've heard some ask for 12 months. So of course, we want to make sure that we have a business bank account and we are keeping it clean. So we don't have our Netflix and all those little subscriptions coming out, right? Also, we have reconciled our accounts so that you may pay people with PayPal, but in your transactions that come into your QuickBooks or Wave apps, whatever you use, there's no double payments where it looks like you've paid the same person twice, but you didn't reconcile it. So it increases your revenue or your expenses, and it's off. It's easy. That's an easy thing to kind of see, right? So, having a business account where only business transactions happen, your payroll comes out, or you can even have notation, okay, this is my owner's draw. You need to be able to show that. And then that money goes from the owner's draw into your personal account. Everything is reconciled. Everything makes sense. It's all clean. That's ideal, okay? It goes to show your discipline financially. It goes to show that you are paying attention to these things. You have a handle on your business and you understand. And then on top of that, being, of course, able to explain why you need this money, how you're going to use this money to actually grow your business. Remember, we spend money on things that make money, right? And then what you're going to use it for, and what kind of return on this investment you'll receive. You spend this money and it should increase your revenue by how much? Okay. You spend this money, it allows you to hire people. All right. That should be clear and evident in your explanation. Okay. And then also, if you're going to use a vehicle as collateral, we talked about that earlier on, make sure there's a clean copy of the car title as proof of insurance. And all that is clean and you are able to present that. So you may have to go look for that and get that ready. Also thinking about long-term, if you're going to go after a loan, you don't have any collateral at all. And like I said, it's, besides having lower credit scores, usually the lack of collateral is usually the second biggest reason people don't get loans, like small businesses. So be intentional before you sell that car or you get rid of that equipment. Maybe it's valuable enough for you to use to actually get some type of, secured loan in the future, a secured business loan. So be intentional now that you know. And then of course, management resumes. You want to make sure that, let's say if I was trying to open up a restaurant, they'd probably tell me no because I'm a terrible cook and I don't know how to cook and I don't have anyone on my team who knows how to cook. But I think I'm going to hire people that are going to do the cooking. I don't have recipes. I can't teach them. I can't monitor it. I can't check for quality. That's risky. That's super risky. But if I wanted to open a consulting firm, I needed money and I've been doing it for 20 years and the people on my team have been doing it for 20 years, great. That's not as risky. That along with your profit loss statements and your balance sheets. One thing actually I learned from a friend of mine at a group called Meridian Management Group in Baltimore, a gentleman named Mark Harrison. He was telling me that he's a CPA and he was saying one of the things they look at is how clean the package is. So if you just go ahead and you print out from your Wave apps, your profit loss and your balance sheets and give it to them and they have been reviewed by an accountant, they don't take that as seriously as something that was actually audited by an accountant or prepared by your accountant, signed off on their letterhead, that kind of thing. He says what he recommends is that you should, based on whatever you can afford, that's the level of documentation that you should submit. So as far as, done by a CPA or reviewed by a CPA, if you can afford it, he said he recommended that's what you do because it makes them more comfortable and pass that on to the loan committee. So